We've got a new letter to add to the latest letters that get used to describe the recovery in this sort of post-lockdown economic climate thanks to COVID. Plus, speaking of COVID, have you been offered maybe a severance or an early retirement package? A lot of that going around Central Florida, particularly, of course, with the proximity to Disney. And so we wanted to give you 7 things that you need to be thinking about if you get a severance or an early retirement option. Welcome to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you every Sunday morning here at 9 a.m. on both the News Radio Orlando network along with 96.9 The Game. An exciting day for our 96.9 The Game listeners, with the Bucks playing the Packers coming up this afternoon. Packers undefeated. Game time 4:25 on that. Our show also happens to be one of the top 25 financial planning podcasts on the World Wide Web, with, at last count, over 12,000 downloads of our program. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this very week to help you change your life with a successful and cost-effective financial plan that provides you superior investment results along with peace of mind for the future. So before we get to all of that, did you hear about the big pay raise that you're going to get if you're on Social Security? Hey, if you're not sitting down, you need to find a chair and sit down for this one, because this is truly exciting stuff. Drum roll, please. The pay increase for next year for Social Security, that cost of living adjustment that the folks in Washington figure out and calculate and award each year. Next year, 2021, it's 1.3%. Yes, that's right. You heard it correctly. 1.3%. I understand. Try not to get too terribly excited. Sadly, that's all. Good luck making that work next time you go into the grocery store. My sympathy's clearly with you if all you are living on these days in retirement is Social Security. If you're not retired yet and want to avoid that fate, then the obvious advice is make sure that you start saving this week for your retirement. Other numbers that were updated along with the 1.3% cost of living adjustment: the maximum earnings limit also was adjusted to $142,800. That maximum earning limit applies for earned income and means that you've got to pay Social Security tax up to that $142,800 number. Each year that goes up a little bit. So obviously for next year, 2021, it went up a little bit. Stay tuned on that. There's a lot of conversation in Washington about potentially sort of changing what income limits might apply for collecting of Social Security tax. So I think we're going to hear a lot more about that, but just know that under current law, the earnings limit for 2021, $142,800, that sort of dovetails off of that 1.3% cost of living adjustment. In other news on what the folks in Social Security did, they also increased the earnings limit. Remember, you've got an earnings limit, meaning a work earnings limit, right? Not retirement income, not IRA withdrawals, not rental income, not pension, not anything else. Work income, if you are under your full retirement age, determines whether you are eligible to keep your Social Security once you start to receive it. So those numbers also got adjusted a little bit for 2021. So the new number, if you are under your full retirement age and still earning, still working, then you have to make sure that that earnings number stays below $18,960, so almost $19,000 for the year 2021. If you go over that, then you have to start giving back $1 for every $2 that you're over that limit. So just know that like the cost of living, like the amount of wages subject to Social Security, so too have the earnings limits also increase. Remember, there's a special one that applies if you are in the year in which you turn your full retirement age, and that number increased to $50,520 for every dollar you're over that, or every dollar of Social Security gets withheld for every $3 that you're over that limit. So you get sort of that special exception in the year in which you turn your full retirement age. But just understand that there is an earnings limit if you're taking Social Security before your full retirement age. So obviously they bumped the numbers a little bit for next year. Just know that those new numbers apply. And then, of course, if you're on Social Security, you would expect to see that 1.3% increase. Sadly, the increases for the amount of money that are currently Medicare is currently on tap for is to increase the amount of how much the Medicare cost will be. The Medicare cost is one that ultimately will be a change that gets announced that could very well, as we've seen in prior years, wind up chewing up a lot of your increase in your Social Security. So stay tuned for the amount that your Medicare is also going to change, because that one has not been announced, and we've certainly seen in years past where that pretty much has consumed all of the cost of living adjustment. They usually cap it so that it doesn't go up and chew up more than the cost of living adjustment. That this cost of living adjustment that they gave could very well be a bit of a Trojan horse, because if you get the increase and then it winds up not being able to have a amount of money that is offset by the amount of your Social Security, then lo and behold, you wind up being a completely offset as a result of that increase in Social Security. So we're going to take a break. When we get back from the break, we're going to continue a conversation that we started last week, but we wound up not having the opportunity to finish. So we'll continue that here on the program. This is Dollars and Cents with your host, Joel Garris, here on News Radio WFLA Orlando. In case you ever wondered if we do this show live, you now have your answer. Welcome back to the program, ladies and gentlemen. Here's the crazy thing. When you're doing the program live and you're not in studio, you are highly dependent upon technology. Technology that can somehow have a mind of its own. So in that last segment, my computer decided that it would be a good idea to update itself. And so the updates happened and the computer automatically shut off, and so we lost all connection. So thank you for bearing with us. If you missed that first segment, again, key concept: Social Security increase 1.3% for this year, or for 2021. Not a whole heck of a lot. And yet to be announced is what the Medicare increase is going to be. So be prepared for that. Usually that one is also pretty steep and ultimately can chew up pretty much all of that Social Security cost of living adjustment that you got. You don't allow that to go more than that, where it actually chews away at your current Social Security level. But unfortunately, certainly what we've seen, particularly when the cost of living adjustment is so low at 1.3% for next year, then you might very well wind up getting a no increase really in your Social Security, depending upon what Medicare increase is that gets announced. They usually kind of delay that one for later, so that one is coming up. Welcome, of course, to the program. Hopefully we'll be able to make it through this entire segment actually on the air. We're Dollars and Cents, where we help you make sense out of life's decisions that have anything to do with your dollars. We are not a tech program, as we can readily attest to that. We do happen to be Central Florida's longest running radio program, back in the day when you actually used to go into a studio and not have to do it all online. Coming to you here on News Radio Orlando Network, along with 96.9 The Game. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary. Our team of certified financial fiduciaries at Nelson Financial Planning stands ready this week to help you change your life with a successful and cost-effective financial plan that provides you with superior investment results along with peace of mind for the future. So we've got a new letter to add to the lexicon of economic terms being used to describe the COVID recovery or the COVID economic recovery. And on the program here a few months back, we talked a little bit about some of those letters. There was a U and a V and a W, and now we need to welcome K from the alphabet into the economic discussion. A K recovery is becoming much more in the discussion of sort of what the world is looking like post-COVID. And so we thought it would be good to explain it so that when you hear it, you'll know sort of what folks are talking about. So economists often refer to the shape of an economic recovery with a letter. And the three most popular ones are your U, your V, and your W. And to sort of recap what each one of those means, a U recovery, sort of if you think of the letter, right? I mean, there's the leading edge of that U where it goes down, and then there's sort of a trough, if you will, that little curve at the bottom of the U, and then ultimately it makes its way back up the other side of the U. So for economic terms, sharp, steep initial recovery, sort of takes some time to sort of come back, and then there's a sharp recovery on the backside. So that's kind of the U economic outlook. A V, as one that I think has been used an awful lot over the course of the past months, particularly when you kind of look at some of the economic data, particularly relating to the stock market. You have the leading edge where a sharp, steep decline, and then almost an immediate turn in terms of the economic recovery. And then the third one is a W, which is sort of like two V's put together. So you've got the sharp, steep decline initially, a sharp recovery, and then unfortunately kind of go through that same cycle where there's another steep drop and then followed by the ultimate recovery. That's your sort of your classic W-shaped economic recovery. So we did a program a few months ago talking about each one of those letters and how each one of them would play out. Ultimately, at that point in time, we sort of thought that it might be a V with parts of a U, depending upon which part of the economy you looked at. And now what's being introduced is a K recovery, and I think that one may certainly have some merit, so we wanted to chat a little bit with you all about that today. And as you might well imagine, if you think of the letter K, you're talking about sort of two lines on that K that go in opposite directions, right? One sort of goes up and the other one goes down, almost like sort of a bi-directional recovery that produces, if you will, winners and losers. And I think that might very well be a pretty accurate description of what may play out. We're already sort of starting to see some of the baseline economic numbers that suggest that some industries, some sectors are going to emerge from this much stronger, while others are going to be permanently impaired. And it's sort of easy right now to sort of pick the ones that are going to be fundamentally impaired, right? I mean, travel, leisure, witness what just happened a couple weeks ago with Disney and that huge layoff, and restaurants, of course, would be in that same category. Other industries are going to be able to adapt. If you're bigger, right, then you've got better access to capital, better ability to go into the equity markets, into the debt markets, particularly with low interest rates, and ultimately get your hands on some cash. So that becomes a big factor in survival, is if you're bigger, you can kind of play game or play in the sandbox for a little bit longer. So beyond the industries and what we're seeing that clearly sort of show that bi-directional nature of a K, you're actually seeing it, unfortunately, on the economic front, particularly when you start to look at the data at the household level. Very clearly in this recovery, or sort of in the middle of all of this COVID pandemic, you're seeing that upper income households are in fact doing better, whereby their jobs are more adaptable, more easily worked off of a laptop, and ultimately lower wage jobs, service jobs, those types of work, those lower wage households are feeling a disproportionate impact on that. And if it goes even further than that, you can look at sort of net wealth figures. Overall household net wealth hit an actual all-time high in the second quarter of this year. Despite the COVID pandemic, overall household net worth hit an all-time high. The problem is it's somewhat concentrated. If you're in the top 20% of household net worth, then that top 20% controls about 70%, 71% to be exact, of the total net worth of the country. And that group saw the most recovery, obviously with an increasing stock market. The bottom 40%, unfortunately, lost ground. And you certainly see that play out in the stock market as well for the 55% of the population that had an ownership in stocks or equities. Equity markets recovered. Unfortunately, the other 45% didn't really see any lift as a result of that. So that's the economic side, more and more starting to look more like a K, particularly when you look at industries, when you look at sectors, and you look at what's happening in households. Now, that's the economic perspective. What ultimately is the investment perspective in this climate? And we think that there are two key takeaways that we want investors to be thinking about. First and foremost, know what you own. There's going to be definitely a difference between winners and losers, whether it's across different industries or whether it's within industries. Not everybody is going to be able to navigate through this. So beware the indexes, beware the ETFs that are required to hold a static cross-section of a particular sector, of a particular market index. Those are not going to have the flexibility to really look for where those opportunities are, to separate out those winners and losers. Because sadly, what will happen as we continue to emerge from this COVID pandemic is that you're going to see different sectors that are able to recover faster. And even within those sectors, you're going to see different people, different players, different companies that are going to be able to do a better job. So selectivity is going to be key. So make sure that you're not just so beholden to an index or a sector or an ETF or an index fund that ultimately means you're just going to own everybody no matter what, without any level of selectivity. And then second, bigger is probably going to be better, because those are the types of companies that are more able to survive, have better access to the capital markets, and are going to be able to get their hands on cash, particularly with interest rates as low as they are. So some important things to be thinking about in terms of where we are in this sort of K recovery. A lot of winners, a lot of losers. Make sure that you are very selective when it comes to your investments and not just owning those broad-based baskets that are static in nature and don't change. We're going to take a break. When we come back from the break, we're going to give you 7 things to be thinking about if you've been approached by a severance or early retirement option. Coming up next here on Dollars and Cents. As with any economic event, and we see it during any type of economic contraction, and we're certainly seeing it now with COVID, there's an awful lot of employers that will offer early retirement, and at the same point in time, a lot of employers will be offering severance packages. And the package that you get is going to be different depending upon where you are and who you work for and sort of the years that you've got in. And so today on the program, we wanted to give you 7 different things to be thinking about if you get an offer or a package like that. So welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you here on the News Radio Orlando network, along with 96.9 The Game. Also happen to be one of the top 25 financial planning podcasts on the World Wide Web. So be sure and check us out at any of our various social media channels. Today, for example, on YouTube, you will see that we're wearing a marathon tie. We're back in the process of training for another marathon, something that we like to do in the fall, and then we run the race in January. It looks like this year we're going to head over to Clearwater. Fingers crossed that the marathon itself actually occurs in today's world. But was out running yesterday and happened to run into a bear. So that'll get you moving pretty quickly. So an interesting turn of events for me yesterday as I was running around. Anyway, my name is Joel Garris, certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this very week to help you change your life with a successful and cost-effective financial plan that provides superior investment results along with peace of mind for the future. So many folks out there are being faced with these decisions that a lot of companies are already making offers about severance packages or early retirement, and certainly a lot more are expected in the weeks and months ahead. And you have to understand, I guess, a little bit of what's going on from a purely business perspective, and not to be just blunt on it, but a lot of businesses see these times as more of an opportunity, if you will, from a business perspective that allows a business to sort of take advantage of what the headlines are saying and use those as cover to ultimately sort of reshuffle their workforce. As you might well imagine, if you get rid of somebody that's got a number of years or offer them an early retirement package, the reality is that you can probably replace them with someone that you're going to pay less. That's the hard and harsh reality of what is happening out there from a purely business perspective. We think there's a lot of opportunistic action by corporations, and at the end of the day, that's what they do, right? I mean, a corporation, particularly a publicly traded one, is focused on generating return for its shareholders. So with every economic decline, the notion of I'm going to replace someone who's making more money with ultimately down the road someone who's making less, obviously that improves a company's profit. So that's the harsh sort of business reality of what's happening out there. We see it. I think everybody kind of knows that, or at least everybody that we've certainly chatted with, they understand that that's what's kind of happening in the background. The other part of it, though, that also is happening particularly now is that it's easy to offer these lump sum packages because you can borrow at much, much lower interest rates. So that gives a company even greater flexibility in terms of what it's able to offer. Just this past week, we saw sort of two different situations. We saw the severance package from Disney. That was certainly an interesting one because this particular person was close enough to retirement, so they could have elected to retire and sort of avoided the severance package. But if they had elected to retire, then they wouldn't get the severance. If they took the severance, then they wouldn't get all of their retirement benefits. So that was a pretty hard decision, but trying to compare those two because each one had some pretty significant pros and cons. And then another situation involved someone working for an insurance company that had an early retirement offer. That one, they were not as old or quite in retirement age as that person that we visited with Disney, but that one, they were younger at age 58, so not quite to that closer to retirement age. And that was a $100,000 severance offer, but because they had been there for a number of years. But the reality is that when you're faced with, okay, now I'm going to have to go find another job, that's going to be pretty difficult in today's world. So no great answers there, particularly then when you roll into the situation, okay, well, how are you going to get your health insurance and where is that cost coming from? And then further compounding the stress of all of these scenarios is typically you have a very short window in which to make a decision, sometimes as short as 30 days or 45 days, where you've got to make that decision. Okay, do I take the severance or do I retire or do I take the early retirement option? And the important thing is that each one of these situations is very, very unique. The person that we visited with Disney had a very unique set of circumstances between severance and just simply retiring. The person with the insurance company, very unique set of circumstances, a very lucrative severance package, or an optional severance package, an early retirement sort of package, but at the end of the day, not quite old enough or not quite in the position to be able to retire. So then the question is, okay, well, what do you do for the interim, and can you really go find a different job, which is a bit of a risk, because if your employer is offering a package for you to exit, then that may suggest that they're not in as good a financial shape as they would be, which could then also mean that your job is at risk anyway. So no good situation to be in right now, and obviously a lot of stress and emotion that goes into it. So we wanted to spend some time sort of sharing with our listeners some of the things that they need to be thinking about if they're approached with a severance or an early retirement kind of offer. And first and foremost of all, it's understanding what's at stake in the offer, right? I mean, you've got to have an understanding of the offer itself before you can go much further. Because if it's a severance offer, usually you're going to get X number of weeks based upon your years of service, and then that's calculated by like your weekly or your monthly compensation. So that's kind of the number that everybody kind of hears when we're talking about severance packages. But you also have to pay attention to another number, which is the health insurance number. Now, granted, typically you can go on COBRA for up to 18 months if you've lost employment, but the real question there is at what rate? I mean, the employer can certainly contribute to that cost, or they could just say, okay, well, you just have to pay the COBRA rate plus 2%. That's kind of like the maximum that you could be charged. Well, that's a pretty wide range of numbers that you may be facing yourself with it when it comes to your health insurance. So, those types of things are important to make sure that you understand what those numbers are, because that's part of the package. That's part of what you're about ready to accept is, how does it play out with my health insurance? Could you go to your partner or your spouse's health insurance? Could you shift there? Make sure you know that full implications of the offer itself, because for a lot of folks, the cost of health insurance serves as a big surprise if they have to pay it directly out of pocket, because for most people that work for an employer, the employer is paying a portion, maybe even all, of that health insurance number. And then when you leave, that means that you've got to pay all of it. So number one, first and foremost, understand the offer that you've been given and understand all aspects of it as well. And then the next question, should you take it? Well, in the case of Disney, you don't really have a choice. If it's a severance and you're getting exited, then on a severance, you don't really have a choice whether you're going to take it or not. You might as well take it and ultimately get that additional severance. But beware that retirement could be an option if you're age eligible, so you may need to kind of think of that. If you're leaving, understand that there are a couple of different implications, that you're no longer going to be able to make contributions to your retirement plan at work, and you may wind up having to draw earlier from those savings accounts. So that's obviously got some pretty profound implications. We're going to slide to a break. When we get back from the break, we're going to kind of continue this conversation of some things that you need to be thinking about if you're approached with a severance or an early retirement option in today's world. So stay tuned for that, coming up next year on Dollars and Cents on News Radio WFLA Orlando. Welcome back to the program, ladies and gentlemen, talking about some of the things that you need to be thinking about if you have been approached with a severance offer or an early retirement offer or any of those kinds of things. But a note of clarification. We mentioned earlier in the program that we were on a run yesterday and saw a bear. Kelly, the producer, and I were talking during the break. He's like, where do you live that you're seeing bears? And in this particular case, I actually happened to be over at the Canaveral National Seashore, because the Boy Scout troop that my kids all are Eagle Scouts with was doing a service project over there. So I was organizing the service project, and then was like, okay, I'm going to go for my run. And I saw this trail in the woods, and I was like, oh, I'll do this trail in the woods. That's, something will break it up, and then that's where I saw the bear. So bottom line is, probably I shouldn't be running in the woods in the morning because the bears are out. Anyway, got me moving, that's for sure. We'll get back on topic here. We'll just want to add that clarification. So there's a lot of things that you need to deal with when you are approached with a severance package or an early retirement package. We were talking a couple of them before the break. To recap, understand what's in the offer, right? Not just beyond, hey, here's how much money we're going to throw at you, but what's going to be the impact on the health insurance side of things. That's a biggie that most people sort of underappreciate or don't quite appreciate when it comes time to them having to bear the cost. So number one, most importantly, understand the offer. Number two, should you take the offer, that really is a function of sort of where things are in terms of that overall financial picture, because understand that if you take an early offer or a severance package before you were ready to retire, the reality is that you're going to have to start using your assets at a much earlier age, and you're not going to be contributing to them as much. So it almost is like you have to be in like uber great shape in order to really fully accept any of these severance or early retirement packages. Otherwise, you're going to be better served by looking for additional employment, which of course is not going to be easy given the economic climate. So those are sort of the first two things: understand the offer, and then should you take it. And then next on the list is understand that there's also an impact on Social Security. Your Social Security calculation is based upon your 35 best years of working. So the statement that you get from Social Security gives you a projection of the amount that you're going to get based upon your salary staying basically the same. If you wind up having some zeros at the end of that 35-year record, well, obviously that's going to bring the average down. So just be aware that beyond, hey, I'm no longer have my job, you might very well have other implications that you may not quite realize, and chief among those, of course, is the impact that you could have on your Social Security. Next is sort of the revamp of the retirement plan, right? It means that now maybe previously when you were thinking about retirement, you were thinking about, okay, well, I'm not going to work. It may now mean that you've got to do a part-time job. Of course, the reality is that the part-time job at like $12 an hour versus like the $24 an hour that you may have been making working makes it a little bit hard to get comfortable with that additional work. So just understand that they may have to revamp your retirement plan to include some portion that is more, that has a work component in there as well, particularly if you've been hit with an early retirement or a severance type of package. So it really does require you to kind of take a step back and relook at, okay, what does retirement look for me, and how do I need to make some adjustments in light of what's happened with my current employment situation. Next on the list, number 5, I think we're up to, is taxes. Understand that if you get a severance in a lump sum, it's going to be taxes. So taxes are going to certainly chew up a chunk of that. Also understand that if you're not yet 59 and a half, you're going to be restricted in terms of being able to pull money out of your IRA. That's going to be subject to a 10% penalty. There are some exceptions on that you certainly want to kind of work through, but know that if you haven't hit the traditional 59 and a half, then you've certainly got some things to be thinking about in terms of structure and in terms of taxes. But know that any lump sum severance is going to be fully taxable. So don't forget about the tax implications as well. And then number 6, you've got to do the old-fashioned math, if you will, to really make sure that severance is going to bridge the gap. Does retirement income work, particularly once you include taxes, once you include the cost of your health insurance? It all comes back to sort of getting a handle on your budget, on your numbers, and really sitting down, pen, pencil, and paper, and really working through the math and making sure that what the income is going to be and what the expenses are going to be, added in the fact that you've still got to pay taxes and you've still got to pay the health insurance. Those two pieces are easily overlooked, and you want to make sure that you bring those in ultimately as you are doing the math on whether this all is going to make sense. So you've really got to sit down, just as you would any financial decision, and ultimately really look at and do the math on what these numbers look like. And then lastly, we would encourage you to seek some guidance. There's a lot of information out there. It's obviously a very emotional time for you, and you're usually under a deadline. So ultimately, that is something that you certainly want to take a moment and try and visit with somebody to help work through those numbers. When we say in every segment that we're here to help you change your life, this is a life-changing event that just happened. And at Nelson Financial Planning, we are here to help you. And the reality is we're more satisfied to help someone figure this out than whatever worrying about whatever revenue might come in. So don't hesitate to call us this week for a conversation about that if you're facing a severance or an early retirement option. We're going to get out and out of here. Thanks for listening to the program. This has been Dollars and Cents with Joel Garris.